The labor market is seeing improvements across the board, but a new survey sheds light on the state of hiring and wages for mid-market companies. Roger Nanney is the vice chairman of Deloitte, the firm that conducted the study, and joins me now on set. And Roger, when we say mid-market companies, at least within the context of your survey, we're talking about companies with annual revenues between $50 million and $1 billion, so a pretty big range there. But you actually say that hiring has slowed, but wages have been going up. Why is that?
That's right. Wages were reported in the survey to be going up by a pretty good percentage. It's the first we've seen it go up by this amount. And we think it links to a report as well in the survey about increasing voluntary terminations.
And how much have wages increased per the survey?
We don't actually survey on how much. What we find is that these executives report that they will be increasing compensation as one of their actions as part of their talent management efforts.
And what do you think the factors behind that decision are?
Well, I think it's, as I said, it has to do with an increasing voluntary turnover in these businesses. With a strengthening labor market, it's important for these executives to pay more attention to retaining employees as well as hiring. Hiring is continuing to be strong, but we've seen just a little pullback in terms of the percentages of people that will continue to be hiring numbers next year.
And the survey also said that these companies have slowed capital investments. Why is that, and how do you expect them to grow in the future if they're not investing?
Well, it's an interesting point. There's a pause, I would call it, in the survey with companies with making major investments. The interesting takeaway, though, is there is an increase seen in technology investments pursuing productivity.
All right, but do you think the overall drop in capital investments has to do with the rising interest rate environment that we're in? I mean, the Federal Reserve is looking for a window to hike rates perhaps sometime this year, and that would, of course, increase the borrowing costs of a lot of these companies.
It could have something to do with it. There are a number of things that the survey points to: a strengthening of the dollar, which is impacting these companies' ability to sell overseas, as well as what I would call, again, a more tactical pause in terms of spending. We still see strong spending on major investments in the survey, just not as high of a percentage as we've seen in previous surveys.
All right, and going forward, how do you see these companies doing? Will they follow the trajectory of the economy? Because we just saw the Federal Reserve last week during their June meeting downgrade their GDP projections for the rest of the year. So does that worry you?
Well, one of the top concerns pointed out in the survey is an uncertain economy. However, this is a confident group. We've seen increasing confidence over the last few surveys. This group, 87% see their business growing next year, and 75% or three-quarters see the economy growing more than 2%. So we'll have to wait and see.
All right, Roger Nanney from Deloitte, thanks very much for coming in.
Thank you very much.
I'm Scott Gamm, and you're watching The Street.